Well, welcome everybody, and thank you for attending. Today's session is going to be an inventory closing adjustment, and we're going to be going into a very deep conversation, well, not conversation, but presentation on the process of inventory closing adjustment. It's one of, in my opinion, when I was new to this product, one of the most mystical processes, because nobody really knew for sure what it did back then. We just knew it was important, and it took a long time. So what I'd like to start with is, rather than the introduction, because you can read about me, I want to kind of cover some of the questions that came in through comments from previous sessions. So actually, I'm going to start with, from here. The first comment: I think that the title, Cost Accounting, is misleading. Perhaps I should have read the detailed agenda. This was not about cost accounting as per, and there's a reference, and let me explain. I usually, and maybe I forgot to do in the first session, talk about what they talk about as cost accounting in AX and cost accounting in the real world. What they call cost accounting in AX is an elegant way of doing allocations. I think they were trying to get to something like a activity-based costing kind of structure. I know people that use it sometimes in projects, but it doesn't cover any of the true cost accounting structures that have to do with cost of items, fully built up cost, those types of things on a per unit basis. So I would suggest that they've mislabeled it and it's not widely used. Now, the other comment is, why didn't I call it cost management? Well, it's only cost management in D365. So when you think of cost management, it's really the functions that are unique to the item costing part of the cost accounting. And in previous versions, that was spread across multiple different modules. So that's why I don't call it cost management, because that only applies to D365. So sorry about that. Misconception, but I didn't name it in the product. It's just what I'm doing is, in my opinion, cost accounting, but it's not the cost accounting module. Okay. Okay, here's another one though. Let's see. Request for a deeper dive in purchase accrual and charges functionality. I believe in the next section, I may be able to add some more detail in those areas. All right. And then question for the next session: the implication of steps for changing costing methods. Generally, there is a formal procedure from going from a regular, some other cost to what's called the new standard cost. It's not really new anymore, but it was new at a time. So there is very much a procedure there to do the conversion part. I really haven't in the past, and I want to do some additional research on it, had any problem with changing to another costing method. It just took the cost from that point forward, the exception being standard cost, because there's just a lot more elements it needs to populate. So in my opinion, going from one costing method to the other is not a problem unless it's involving what's called standard cost now in this current, and then it's only going to standard cost. But let me go ahead and do some additional research for the next session. And I think that's covered the questions from session number 1. Now I just want to go to session number 2 real quick. Want to know how AXUG is connected to MS Partner and Customer Source, as sometimes we cannot find the answer. Is if any dedicated to the discussion can assist or follow up for questions which are not answered. Well, first off, I've left mine up, donriggs@busproduct.com. If you have a question regarding this session or other areas, feel free to reach out to me, and I typically answer next half day or next day most questions. If you're a member of AXUG, there's a form there that you can propose questions and get answers from people such as myself and or other users. So that's another place. Regarding those other elements, and I'm aware of those elements, first off, think of AXUG as a customer-driven form. It's enticing to people like myself is because I can reach out and talk to users of the product. So that's very important. MS Partner Source and Customer Source are areas where you can get information and also technical information regarding the product. They are not directly connected in any way, at least at this point, but again, they serve two different purposes in two different marketplaces. And again, either using the forms is a good way to get questions answered, or again, you can reach out directly to me. Another thing that was asked was access to D65. Even I'm willing to pay monthly fees. I would suggest to reach out to me directly, but there are programs that you can, if you're a customer or partner, you can get directly involved in to get access. If you're an independent, by the way, I'm an independent who champions independent people in this industry. I can help you get connected with some ways you can get access to that information. So if you're an independent, or even if you're a customer or work for a partner, I can give you some advice in those areas. Let's see. Okay, I think that covers at least the questions we have right now. There was also another one talking about, can we do some other sessions like this for production and inventory? I would be amenable to that. It just is not going to happen until after Summit in October. So we're talking about more of a first of the year type of time frame. All right. So again, just brief introduction. Been in the industry a long time, over 15 years Dynamics. I have been on the post-sale side, so I've done many ERP implementations. They're not all in AX. But I've got quite a few in these. I was APEX certified, that's American Production and Inventory Control Society, certified in the early 80s. I've helped design ERP systems, and I've published many articles in MS Dynamics world. I would also encourage you, that's an organization to look into. There's no cost to get access to their website, and there's a lot of published articles from people like myself that provide a lot of good content. And one of my industry focuses is costing and costing processes, and that's because I tend to gravitate towards something somebody needs, but nobody's necessarily addressing. So costing has become one of my areas of specialty. I've done a lot of training of cost accounting people, and I've also done a lot of working with people on fixing broken costing systems. And next session is really going to talk about how you can avoid having me have to come in to help you. So, so that's what we're going to do next session. Now, getting into content. Works better if I hit it on the right screen. One thing I do want to suggest to you today, that I had a problem with my D365 system. Keep in mind, it's not a production system, so I don't get the highest priority. I effectively did not get a chance to update some of the slides. So many of the slides are going to be on 2012. It would be my intention to retrofit that and post that back up to the site. But of course, the recording is going to have 2012 screens in them. I want to suggest that functionally, they're the same. There's not a lot of difference between 2012 and 365 as far as functionality. The screens will look slightly different. I apologize to you, but the show must go on. So what we're going to cover today now is we're going to talk about what the elements of inventory close and adjustments are. And that means what are the associated pieces that are within this group, because there's the close, there's the recalculation, there are adjustments. Those are the three major things that happen in this area of the product. Then we're going to really say, what does it do? What does the close process do? Why do they run it? What's its importance to me? Then we're going to talk about recalculation and why it's important. Recalculation allows you to get out of your weighted average date costing, which is the native mode it works at, is with the exception of standard cost, and gets into things like our LIFO and FIFO layers. Then we're going to cover how do we fix improperly posted transactions. That's what adjustment does. When you think of adjustment, think of we're fixing something after the fact. And then we're going to talk about best practices. And like I think in the other sessions, like I talked about, is I've went out to sites and had people ask them what costing method they were on, and they've told me proudly FIFO, and I ask them how many times when do they do inventory close and recalculation. They say never. They've never been on FIFO costing because it is an adjustment from weighted average date, or what they'll call running average, which we very typically call average cost. Okay. Okay, so what are the elements of this area? Okay, first off, we have the closing and adjustment screen. And this is effectively where we can see the closing and adjustment results. This, by the way, is a 365 screen. So, okay, so inventory close. Inventory close is very important because it makes sure that transactions that meet the criteria, we don't have to look at it anymore. And so what that means is it takes and settles issue transactions with receipt transactions that are fully financially settled on both sides and closes them. Why does it do that? So it doesn't have to look at it anymore. It really is a process that makes the inventory close more efficient and says, okay, these transactions are fully satisfied. You don't need to consider those. So what does it need to consider? Anyone that's not fully satisfied. And we'll talk a little bit about that. Like what happens when we post an inventory receipt or some manner purchase a receipt and never post a vendor invoice. What does that do to the system, and why is that a problem? And again, the next step is, and we've talked about, until either inventory close or recalculation is processed, other than standard cost, you're going to be operating in average cost price, and it's weighted average date. Now, you'll notice that AX terminal, they use running average cost price. It's really the same as weighted average date is what it is. Okay. Again, after the close, it's no longer possible to post inventory in previous periods. So you got to be careful about running it too. You don't want to run it in the middle of the month for the end of the month. By the way, if you do, you can cancel it, and people do make that mistake and do it. But the bottom line is that it's closing inventory for any past transactions. Typically, the frequency that we run it is once a month, but that does vary by company based on the volumes and any other types of things. It also is not unusual to run the recalculation on a daily basis if you're using something like FIFO, because that gets you in your FIFO layers before the end of the period. Okay, transactions financially settled. If you go here from the right, and this is just a purchase order and purchase order return, you'll notice that the amount settled, and that means financially, is the 161. It's those two cancel each other out. The physical cost was that, and the financial cost was that. So there's no change or no adjustments that need to be done in this transaction. But the key is the amount settled. Keep in mind, the amount settled does not have to be the total amount. Again, the amount settled does not have to be the total amount on any individual transactions. In other words, I could have a purchase order for 200. I could have done the vendor invoice for 200, and I could have sold 100 of those, which means I would have settled against 100. Okay? So closing settlements, what you're going to see is you're going to actually see it create a settlement based on a principal. And these are for purchase order transactions. And there was no, again, this is actually this one, and it created no adjustment transactions. When we look at the transactional level, what we're going to see, and it's in your update tab, you're going to see not only if any adjustments had been made previous to this, you'll also see the date it closed, the settled amount, or settled quantity and the settled amount. So when we think of settled in the these are transactions that have been fully satisfied within the system. You'll also notice it's telling it both physically and financially posted because it has to settle. Okay, recalculation. Okay. Recalculation is similar to an inventory close as far as what it does, but there are some important differences. The other thing too is at the end of a close, you can also do a recalculate for the beginning of the next period. So I want to make sure you know that too. That's what that little flag is for. Do I want a recalculation? The answer is, if you say yes, it'll recalculate your first day of the period, the first day of the period past that. Okay. Recalculated transactions will not be closed. So the closing is only part of the inventory close. Recalculation, its primary purpose is to get you the adjustments are needed. And we're going to go into this in detail on what causes these adjustments. Why do they happen? One obviously is to get it in the LIFO or FIFO layer. So we've covered that, but there's other reasons why recalculate does adjustments. You also can be specific about recalculation. So you can run it for specific items, item groups, or warehouses. So now I might want to recalculate just one item. Maybe I've done something that, or something has transpired that I want to do a recalculation to look at the effects. The fact is I can do it selective is important. Also, it's going to recalculate them for the present period. And again, we're really talking about, well, what they're really talking about is that a recalculation within a period, every time I recalculate, it recalculates as of the day I'm recalculating and cancels out the previous ones. So think of it as just reshuffling the deck and picking up new information that occurred since the last recalculation. But it's not additive, it replaces the recalculation value. So it kind of cancels it out and then writes a new footprint out there. And what there's a warning is say, look, if you run recalculation for a group of items, it does not mean that you're going to get everything within that bill of material structure. So it's really just saying, look, if you recalculate a group, you can't expect it to recalculate everything associated with that group. It's only going to recalculate for those products within the group. Okay? All right. Recalculate adjustments to align current values. So what we're seeing here is you're seeing two FIFO adjustments, one positive and one negative to align the FIFO layers. This example, and we go through this example in detail, but keep in mind, a FIFO layer says the first cost, and the first cost here was 100, let's say it was 102. The second cost was like 204, and the last cost was what, 304, something like that. What this is doing is subtracting an average of 200 and makes one 300 and something and one 102, let's say. So it's adjusting to those FIFO lever transactions, okay? So, and really what we're showing here is how it creates adjustments to align to the current value. So what it's saying here is this did an adjustment of $100. The physical cost was 102. The cost amount financially was 205. And in this case, it's probably because we received the purchase order at 102 and we got the vendor invoice. It was 205. So it had to do this $100 adjustment to this transaction. All right. And probably something similar here. This was 175. So the adjustments have to do with the time that we physically transact against it to the time we have the financial results. And it says we have to make an adjustment to this transaction because of this delta between the physical and financial. And we covered physical and financial last time. So you get an idea, though, is that from the time I receive it, I could, in fact, have transacted like a sales order. What that means is that the sales order cost of goods sold in this case might have been $102. It's saying we have to make an adjustment of $100 anywhere that was physically issued to update the transaction to reflect the real financial cost. So this is what your settlement looks like. It's an adjustment of $100. And I'm not sure I think I just said insurance expense, but really what it boils down to here, it's doing an adjustment. So this looks like adjustment between an inventory or actually an expense account, because this is the offset looks like some manner of inventory account. But what we're saying here is it will make adjustments to transactions after the fact is what it boils down to. This is some manner of inventory clearing account or adjustment account. Okay. And again, this is just, we're going to go into more detail. These are just explaining the pieces. So we've talked about inventory close. We've talked about recalculation at the high level. Now we're going to talk about adjustments. Adjustments can kind of get lost in the shuffle sometimes when we talk about inventory close, because inventory close and recalculation kind of work together is what it really boils down to. Inventory adjustments, on the other hand, are allowing you to make adjustments to an inventory that was transacted improperly after the fact. So let me illustrate. For some reason, what would be a good example? Usually the best example is production order, because purchase order, remember, you've got that, unless you posted the invoice wrong, you usually have that feedback as to what the vendor is expecting. But on production orders, let's say you closed a production order, ended more appropriately, ended a production order, and you hadn't posted all your labor. Let's say they overwrote it or whatever reason. So what happened is you ended up with a transaction, and whether it's standard cost or some actual costing method, the adjustment can do something different. So let's say in actual costing, you can make an adjustment to make that value of inventory to the value that you expected it to be. You can't go in and fix the production order. You can do things like relieve the inventory, and I don't want to maybe next section I'll talk about that, but you can do like a BOM build and a BOM journal is what you can do, and reverse out the effects of that inventory transaction and then post it back in again. There's a lot of different ways you can fix it, but you cannot fix the production order, except if you adjust it or you adjust items that were used within that production process. It will go in and make changes to that production order after the fact. And let me illustrate. It cannot change the value of what you financially settled coming out of inventory unless there was a product consumed. And this is a very difficult process. If, let's say I consumed a product and it was $10, and that product had an adjustment to it of $10. It would, after the fact, go change that inventory transaction and add $10 to either the value of the end process or a change to the variance. What it can't do is do anything that didn't happen. So if I never posted the inventory, it doesn't make any difference what happened with inventory. So again, I ended up with a production order that effectively came out as $10 and needed to be $20. Now in a standard cost, it might have been a standard cost of $20 and $10 went to variance. In the case of an actual, the actual was $10. You can do adjustment to that, and it'll either impact the variance in a standard cost in this example, or it would change the cost on the outcome of the transaction. And we'll see more examples of that. And I'm hoping that Julie, do we have any questions about this? Is there anything that's not clear about it, because it's a difficult concept? But
if you have any questions, folks, you can enter them right now. We do have one question. I'm not sure if it's relevant to where you are in the concept.
That's okay.
Okay.
Let's go ahead.
Yeah, it says, how do you add inventory carrying costs which are applied to ABC calculations?
Well, first off, you're not going to apply anything to ABC calculations. If you want to, let's say carrying cost really has to do with additional costs that you want to apportion. They would be like an overhead many times. The way you do that, and we're going to cover it next session, is before 2012, you would do it as a lot of times a miscellaneous charge. A miscellaneous charge then can be apportioned to the cost of the materials in inventory.
All right, good.
Okay.
And then several other folks saying that your information is clear. So go ahead.
Okay, good. Good. So there's two kind of adjustments, and that's what, and we're going to go to them in more details. But so adjust again. So you've got adjust transactions, okay, and you're adjusting on the receipt side, just so you know. And then you adjust on hand. That can only be done with an inventory close, and that's making adjustments to your on-hand inventory. And also, by the way, the downstream processes where the on-hand inventory was used. Right, and so what I'm saying, it's the most effective way to fix incoming transactions that are wrong. Once they're financially closed, you want to adjust the value of either the transactions coming in, which means that'll affect the transactions that have been outgoing, and then once a month you can rechange the value, rewrite up or down the value of your on-hand inventory. By the way, this included standard cost up until 2012. 2012 and forward, they did an adjustment when we did a cost change. Before that, they did not. Okay, so you can select a transaction to adjust, although edit now is the one we're going to adjust. So when you see edit now in the cross, this is what I'm going to do. I'm going to make this adjustment. And so you can see it made the adjustment of $298. And here's the resulting transaction change. quantity of 10, the adjustment was 298, the physical cost was 102. I believe if we add these two together, that adds up to 400. So what it's saying now is the financial cost was 400 on this. The physical cost was off. By the way, one of the things you do to make your costing better is your physical cost should be more representative of the financial cost. When you see an adjustment of 298, there's something drastically wrong in what you're anticipating a cost is going to be. If it's on the purchase side, your purchase order does not reflect what you're paying for it, is what it boils down to. Inventory close process. Now we're going to go to it in a greater detail. So we talked about it before. It's going to settle transactions between the issued and receipt that are fully financially accounted for, is what it's going to do. So here's your closing and adjustment screen. So you'll see closing, and then recalculation is going to always occur for the period after the close. So in other words, I can't go backwards from the last inventory close and do another recalculation unless I do what's called a cancellation. I can cancellation the closing impact, but I have to cancel the whole thing in order to be able to change anything from that date backwards. Pre-closing actions. What should I be doing? Hold on just a second. I had to try to clear my throat there. Okay. So let's talk about some of the things we can do before we close, and maybe even institute a fix before we close. So I'm putting in here inventory model groups are correct on individual items. Here's what I'm saying. The biggest reason like inventory goes out of balance with physical inventory, one of the biggest reasons I found is improperly set up items. I'll give you an example. I've got a service item. A service item should never hit inventory. A service item is supposed to hit an expense. If you hit inventory, you're forcing your inventory out of balance with your physical inventory because a service item has no footprint in the inventory. So make sure your model groups are correctly aligned, and that's part of what you want to do to make sure. It doesn't necessarily impact the closing as much as when you're trying to close the month, but it was not a bad place to put that comment. So again, one of the biggest problems forcing inventory out of balance with ledger are improperly set up items. And that's both on the model group and the item group. Okay, run the open quantity report. I'm going to show you that. What that does, it gives you a list of transactions that are going to remain open after the inventory is closed. Why is this important? Well, do you think a transaction that's out there from 1998 is not important to do something with? If you have transactions that are sitting out there before this period and you're not going to they've not been closed during the period, those will stay out there, and whatever adjustments are going to come out will occur in the next period. So you got to clean up old transactions. Because the impact, when you do clean them up, will put them in the current period. And that's part of what we're going to cover in greater detail. But the open quantity report says these are the things that will stay open after. And quite frankly, you shouldn't have much of this open. The next is the check cost prices. And what this allows you to do is set a maximum deviation, and that maximum deviation can be then compared against item cost price is the one I usually use. And this is why I'm also suggesting to you that if you're not using standard or a standard cost type of inventory, you should always have an item cost price, or what's also called a plan cost, because that allows you to compare transactions against that. Oh, again, it gives you a report that says these are the things that are outside of a normal, the normal cost that I'm anticipating. Why do you do that? I may want to take advantage of doing an adjustment before I do the close. Okay, so here's the check open quantity screen. I've got an expected closing date. Keep in mind, this does no transactions. What this is saying is show me everything that I'm anticipating is not going to close if I were to run a close for this date. And here's what it's saying. Like, here's a particularly bad one. Here's a purchase order that has been registered, but it's never been actually received. And I see this a lot where we've done a registration. It's more often going to be happen in the newer versions, because when you have the WMS, you can register something. If you're not using the new WMS, you typically didn't use the registration process that often. And just for you all to know, a registration means we've identified that it's here, we just haven't put it away yet. So here we're seeing items that are registered. These have never been fully received. And then the other ones you can see, I've got received, but I've never processed a vendor invoice against it. So it's very important. If you get 50 pages of this, which you very well could, this is something you need to look at, because you have transactions that have never been fully settled out there, and you need to take some process to start resolving those. And if you've left them out there for years, it can be pretty messy. The next is check cost price, and you can see what I've got set up here as I'm using item cost price. I'm saying, give me anything that's outside of 50%, pretty big margin. What I typically do, by the way, is when I'm working on costing systems, I'll start with using fairly wider, things that I'm saying, give me the big chunks first. And just like when I'm working with a costing, I'll look at the adjustments and say, I'll sort them by the highest adjustment to the lowest adjustment. And then that's where I'll start to look at those items to try to say what's wrong with these items. Because the adjustment is an indication that you are not performing to whatever that standard is, or whatever you think it's costing you. So what this one does then is it produces a report that says, okay, this was outside of the deviation. Now this one says there's no unit cost price, so it's just warning you, say you have nothing to compare it against. This is one that happens all the time. Notice you've got accounting journal. What probably happened here is they counted everything else and counted it back in. Well, guess what? When you count it back in, it comes in at zero unless you have a planned cost.
Don?
So with this, yeah, go ahead.
I have a couple of questions relevant to this, so I want to get them in now. One is, does the check open quantities report exist in 2012?
Yes, it does.
Okay. And
it may not be called exactly that, but it's in that same area. Okay.
All right. And the second question is, and the check cost prices, question mark. I don't see a patch similar to what you are displaying. She must be looking in 365.
Okay, well, let me explain. Remember, I got part of these done, part of them not done. So let me kind of give you an idea here. Check almost quantity. This is a 365 screen. So this is an open quantity, this is a 2012 screen. Apologize for that, but let me talk about it. Now, I believe in cost management on 365, it's implicitly shown. On 2012, you have to go to inventory close, and it gives you 3 steps. First step is check open quantities. Second step is cost price. Third step is the actual close itself. Okay?
Great. Thank you so much.
It's just hidden in 2012 is what it is. Because people are afraid to go in there because they think they're going to do an inventory close. No, when you open that, it actually will give you the option of running those reports. And even if you clicked on inventory close inadvertently, you can just go out of it. So keep in mind, you can run these reports at any time too. And to me, the cost report is very vital to run during the month. All right.
All right. So, good to go.
Okay. Okay. So again, if you look at 2012, it actually comes up with, I don't think I'm showing it, but at the first step when I say inventory close would be check open quantities. Next would be check cost prices. And then lastly, it'll go to inventory close. Okay. Now, a couple things. Let's see. I'm sorry. A couple things important to note here. You'll notice that you have an inventory close up to date. You can use your normally you're going to use it for current period because you're going to use it as part of your monthly close. In certain cases, you might want to close earlier in the month. So in other words, you can do an inventory close at any time, as long as you understand whatever that close date up to is going to be the date you can't go back in and make inventory changes. So it can be run more than once a month. It typically is run once a month in conjunction with your financial close for the period. The other thing is you can run a recalculation after the closing, and that is to prepare your items for the beginning of the next month. So anything past that period then will also run a recalculation in the new period for anything that's still out there, transactions that have not been satisfied. All right? I always do a recalculation because I see no reason not to. Okay, so then we look at closed settlements. What it does is goes through and tells you all of the different settlements that it had. So a settlement has to do, you'll notice that it doesn't have adjustment because there wasn't an adjustment. It's saying I went through and I found offsetting transactions that I can close these specific transactions. In other words, mark, I don't have to look at them again. And that's all they're really saying here. Is this counting journal, I had an offset where I used it, and it now satisfies the total financial. And the reason why, you see 2 here, if you look at the counting journal, it does a physical and financial transaction at the same time. So it is comparing the issue and receipt side to close this out. And here's a production line down here. Okay. Again, the main purpose of inventory close is to look for transactions that can be closed, that are financially settled on both sides. You do it based on a horizon, and recalculation it can be part of it, or it also typically is. If you haven't done a recalculation, it does in a sense, the same thing as what a recalculation would do as far as creating an adjustment. And we're going to cover later why these adjustments are done. Okay? Recalculation and its importance. One of the things we did cover, by the way, how are we on time? We're good. Okay, good. We're doing well. It makes adjustments to inventory transactional correct costing methods. We've talked about that. In other words, getting in the LIFO and FIFO layers. It also makes adjustments to issues based on received cost wherein the financial cost came in differently. So again, if I posted a financial cost like I sold it, but when I sold it, the received cost was $100, but when the vendor invoice came in, it was $200. It would adjust the, in this case, cost of good transaction to increase the cost of goods by $100. Okay? Let me ask the team a question. What if the purchase order vendor invoice was posted in the next period? So let me go through the example. Period before, I received it, I sold it, I invoiced it, closed the period. Now I come to the next period and I do the financial, the vendor invoice comes in at $200. What happens to cost of goods sold?
All right, enter your answers in the question box. We'll see what folks think, or if they have an idea. Nothing yet, Don. Oh yeah, here we come.
Okay.
So we've got a couple that say it gets updated with the vendor invoice price, and another that says the cost of goods sold would get adjusted.
They would, but when? That's the question. They're both right, but when? In other words, what period?
Recalculation, or in the same period?
No. Is that you guessing?
Yeah, those are what they are.
No. And here's what's vital to understand, and why it's very important to understand why you want to try to close your financial transactions within the same period as much as possible. Your cost of goods sold adjustment now will incur in the current period. So therefore, your cost of goods sold in the previous period, for all practical purpose, was incorrect. It'll make the adjustment in the current period. So what we talk about when we talk about improving the process, there is no reason to have production orders open for multiple periods unless you're building a ship. And there's, wherever possible, you want to make sure you've got your vendor invoices posted. Because if they're different, they will occur at a different period. And the same thing is true on a production order. If I did a report is finished on a production order in period 1, and that report is finished, which is based on the anticipated cost was $100, that cost of goods sold would have been posted against that sales orders for $100. Now, period 2, I end, and it comes out that item was $200. That $100 now gets posted in period 2. If I look at the transaction, I can see the adjustment, but the cost of goods sold hit at a different time. The fact that it does it is great, but it requires a certain discipline. So people got to understand the impact of not ending your production orders, not timely posting your vendor invoices, and you want to try to get them as much in the same period. And we'll cover a little bit more of that later, but that's the point I wanted to make, is that it can occur in a different period. Also, recalculation provides for a revaluation of on-hand inventory on anything prior to 2012. So when you look at on-hand recalculation, that is only applicable to items previous to 2012. We're talking forward and before. In 2012 past, and the reason why they don't have to do it, remember, it's primarily reevaluation on standard cost, because when you look at your on-hand inventory, they are valued by your transaction sets. But let's talk about what the real problem was before 2012. When I changed my standard cost, it would want to change it for the whole period, but it didn't change it for on-hand inventory. So if I went from $6 to $6.50, the 100 in on-hand had no footprint in the ledger to say that the value of that inventory went up by X%, because they didn't post the transaction at the time the cost change was made. 2012 forward, when I changed the cost, the standard cost, it created an adjusting transaction automatically, which was more in line with other systems I'd worked with. So what that means, I don't have to do that revaluation, because it's revaluing that inventory at the time that transaction is posted. And for any of you that's
interested about that, Don, if you don't mind me jumping in.
I'm sorry?
We have a question about that, if you don't mind me jumping in.
Sure. No, not at all.
Michael asks, he says, we have shipments coming in on a boat from overseas, so a lot of times it's not possible to financially close a receipt in time for inventory close. What do you recommend in those types of cases?
Well, first off, let's cover that. If it's coming in from offshore, I do understand that there is a time. Keep in mind, we can't ship it till it gets here. So let's say now it's received. So really the time we're talking about, from the time it's received to the time that we have the vendor invoice. And I understand you got customs, all that kind of stuff. I'll cover it more next session, because I believe I'll have bandwidth to do it, because I want to combine a fully built up cost. You may not know the total cost. You may know what the vendor is going to charge you, but you may not have accumulated the total cost. We typically use accrual methods to get to that cost. And let me illustrate. If I anticipate that my cost of freight getting it from offshore is, let's say, 3 cents a pound, I can put that in my standard cost as an anticipation of those costs to come. But you're absolutely correct. If you want to do an adjustment after the fact, when I understand what those costs are, a common carrier would be an example too. I got my freight bill, now I'm trying to apportion that to my cost. Those costs will in fact be incurred after the fact, and that's just a factor we have to deal with. I want to make sure you're aware of what the impact is, and that's why a lot of people will do an accrual or an anticipation of those costs, and then look at that as the cost over under absorbed. In other words, a shipping cost I might say a shipping cost of 3 cents per pound, which goes to a freight outlet, or no, a freight in, let's say. I can then also compare that to a posting of that freight in account that might offset that freight expense, if that makes sense. But you can accrue for it, but the timing maybe it hits a different way, and the best way to do it for it is to accrue for it. I hope that answers the question. And we'll cover more about how you might do that next session. Okay?
We got to thank you. So
okay. Good. Yeah. Because there's some of these that you can't avoid. It's just you want to minimize their impact is what the key is. That's why the accrual is one way to do it. It may not be 100% accurate, but it is representative. So you've got more of the cost hitting that period is what I'm trying to say. Okay. And again, what I just illustrated, I'm going to cover. So it's I must be clairvoyant. So again, timing issues for physical versus financial. And again, I just covered but let's go ahead. So I got a little ahead of myself, but let's go ahead and just go back, drop down through this just to reinforce what we talked about. Purchase order received at $10. Item is sold in the invoice, the resulting cost of goods sold at $10 in the period. Then the vendor invoice is processed. Adjust the cost of goods sold of $20 in a different period, of $2 in a different period. I'm sorry. So you get where this is exactly the ample zone talking about. And it's worth with production orders, but you should be able to control that. Because production orders have more possibility for variability than a purchase order does. A purchase order supposedly is an agreement between a vendor and a customer as to what we're going to pay for something. So in some way, we control that relationship. On production orders, we don't have that offsetting that says this is what it should have been. So a production order can be all over the place, so it's very important to end those. So what I'm suggesting is every production order should be ended in the period that it is produced. Purchase orders, you want to try to get as many. That means if you leave the period open for a couple of days, 2 or 3 days to get the vendor invoices in, that's not a bad thing if you can do it. Because if you get more of it in, your period's going to be more accurate. So that's why sometimes people keep it open for a couple of days just to get the vendor invoices in. All right?
All right, Don, do you think this is a good point to break for a minute or two?
Right at 12. Amazing, huh?
Right.
Amazing. Okay, well, yeah, I think this would be a good time because we're getting ready to go into something else. And so we've got a lot of reiteration and more vivid examples of some of the things we've talked about, but that's part of the process learning is to reinforce what the assumptions are we've talked about. So really, I'm thrilled to be teaching you all, and go do what you need to do, and I'll see you back here, in like 15 minutes?
Or even 10 after the hour is good.
Okay, because I'll probably be on 10 after the hour or even before that.
Absolutely. Okay? So take 10 minutes, do what you need to do, answer your email, visit the restroom, and we'll talk to you at 10 after the hour. Thanks, everybody. Hey, Don, you're back?
I sure am. Oh, so I think it's going fine, isn't it?
I think it's going very well.
Okay. Well, I've done so many of these now that I'm actually relaxed. You know how you're always
I know.
uptight? I mean, it's like I'm just talking to people just I talk to them normally. So there's some benefit to repeating, but I started this because there wasn't anything. There really wasn't anything for the longest time. You had to go to multiple manuals to pick up the information. So I've been doing these for a long time, this level. In fact,
It's so much better. Oh my God.
yeah,
Yeah.
the to me, this and the other one I did earlier last year represented the most comprehensive seminar on costing that I've ever seen.
Yeah.
There's a lot of people, and the thing that I like to share is my experience with the stuff. That's what I think is what I can do that, people that haven't done it as long don't have the opportunity. And I really do want to do things on inventory and production, particularly production, because I can help people get to things like capacity planning and scheduling that you have to really know what's important to get it to work right. Because, it's all, well, again, I've had a good career. I kind of enjoy what I'm doing,
No
sharing
kidding.
with people.
Yeah.
Yeah.
Perfect. Okay, so hey everyone, can you hear us? We do have a question again before we start.
Sure.
And this is from Muhammad. And Muhammad asks,
Okay.
what is the recommendation for including consumables or overheads to get accurate production cost?
Okay. Well, a lot of that I think was covered before, but let's talk about specifics because I think it's very important because first off, anything you can use on a bill, you should. Anything you can't, you don't. I mean, when you look at it, you can backflush materials, so therefore you don't have the necessary need to order them. And if you can say representative what we think it takes us on these consumables, if, remember, the thing is if, we can in fact backflush them and get that cost into the system. The advantage you have is that then you have an anticipation, you have a true inventory of the consumables. So a lot depends on what we mean by consumables. Also keep in mind you can have a fixed cost. I'll give you an example. I've worked with people that used what's called a mandrel, and let's say they're building something over that mandrel, but once you're done with that production run, that mandrel is useless. And let's say that mandrel cost you $100. You can, within your bill of material, have a one-time cost and not relative to the number you're building. And when we look at overhead, here's what I try to get people to understand. You want to get as much direct cost as you can into the product, and that's why I talk a lot about fully built up cost. So therefore, things like labor should not be apportioned. You should backflush it. You don't have to post it. You can backflush it to make it representative of the labor content within any given production process. So anything you can apportion to the product, you should. As far as overhead, it should support typically, it will typically support fringes, utility type costs, other type costs that we want to portion it and get to the item. The thing I want to caution people is, as much as we want to get costs into items, it should not necessarily be totally drive the decision to make or buy or make offshore compared to making in the continental United States or wherever that production entity is based. I'm going to suggest to you that there are hidden costs that many times we don't accommodate through these things. So we just want it to be fair. When you're making an evaluation, one of the biggest problems people talk about is not being fair is how we allocate cost and how we recognize cost in a competitive situation. So you need to understand all of the cost, I think, associated with it. And I don't know if that answers the question as much as at least I think we put a framework around it. Any follow-up on that, Julie?
Nope, just a thank you. So I think you're good to go on.
Okay. So, all right. So recalculation based on transaction timing example. Okay. So here we've got the PO received. And we can see this is, and by the way, some of you have seen this example. This is the first, it's effectively, we received it at 20. The PO then is, so the PO is received at 20. You can see the transaction here. We got 10 at 20. Sales orders processed, we sold it for 40, but the transaction cost of goods sold would be hit then at 200. So you're seeing the offsetting transactions here. So here's your physical cost amount. There's your received cost. And the reason why you're seeing this cost amount being 200 is we went ahead and invoiced it. So now we've got an invoice that reflects a cost of $200, which would have flown to our cost of goods sold. By the way, here I'm showing some of the things that happen. Another thing that's important to note is that any additional charges that you want to show up on the freight invoice itself is going to occur on the financial side if it's a miscellaneous charge. So again, when I receive it, I'm going to receive it at the anticipated purchase price. Any other costs are not going to hit until I do the financial voucher. So in this case, I've got a $20 freight charge. So I'm allocating the freight charge to the item. And you can see my allocations here, my line level charges. So my purchase order cost is going to be $200 plus the $26 in other types of costs. And that's coming from those fees that are associated with it. So during the recalculation process, we're going to do that $26 adjustment, which will in turn create a ledger posting, okay, offsetting my COGS, or adding $26 to cost of goods sold and offsetting it to this is more like an inventory accrual, a clearing account, or changes to inventory account. I'm used to seeing more in an expense account. So that adjusts your COGS. Okay, so that's really something that is a standard thing that happens. It really then does cover too what the effect on charges. It will not do anything with the charges until it does the vendor invoice. So that's another thing you need to be cognizant of. There's ways around that on the standard cost side, but that's something we'll cover a little bit later, because you can make those anticipated costs part of your standard costs, and then you wouldn't see that variability. In an actual costing system, you would. There's not a lot of ways to avoid that. Okay, then we get to, okay, recalculation based on adjustment example is what we're doing here. So a product is sold on a sales order. PO receipt was received incorrectly. So we sold it, but we sold it at $100 a piece, right? We sold it at $1 a piece because our purchase order was wrong. And let's say in this case it was received wrong. We do the adjustment process. And so we're actually adjusting it. The edit now tells me what I'm going to post. So I'm going to actually write this up, $1,900, these transactions, which results in the cost amount going from 102 to 2,000. Which I think in the next one it shows you on a, oh, wait a minute, let me just go back. So 100 to 2,000 would be $200 a piece, right? So these items that came in at a little over $1 a piece, $1.02 a piece, and were actually items that cost 2,000. So you can easily see this in a production order. I use purchase order because it's an easier example. In theory, you could have got a vendor invoice input incorrectly, right? So it could have been or we accepted a variance, so it could happen in a purchase order too, and does happen. But I wanted to show a fairly vivid example of, in this case, you had a large mistake that impacted your cost of goods sold. So I ran the fix. Now when I do the recalculation, I'm going to do the FIFO adjustment that I've just calculated to the sales order, which results again in the sales order getting adjusted to the amount of $11,000 on your cost of goods sold. So that's your delta to cost of goods sold. So again, what I'm trying to show you is that what the purpose of adjustment is. What adjustment has to do with is a financially closed transaction that's been done incorrectly. More likely to happen on a production order. Much more likely to happen on a production order. But that is your process for fixing it. So if you closed a production order and it should have been $200 per unit rather than $100 per unit, you can in fact fix the process coming out of it to represent the right. So even if it was sold, it will go back in and through its recalculation and inventory close process, fix the cost of goods sold. Clearly, you want to try to do that in the same period if you can. And the only way you're going to see that is by if you end it and you find out after the fact somebody ended it and they shouldn't have. One good way to find that out is by running that cost report that you have during inventory close. And if you ran that before the close, you would realize that that inventory was posted if you had a planned cost or standard cost. Well, if you had a standard cost, it would have posted a standard. But if you had a regular cost or actual cost, you could see a big variance there in that, and you'd say, okay, what did that affect? Or do I need to adjust this because we are going to affect things on the downstream process? So I hope that gives you the example, and how you find it usually is again through running that variance report on the cost, which you're comparing to a planned cost. Questions?
Not a single question in the queue right now. So.
Okay. Again, I'm hoping you can see where we use adjustment. We use adjustment on financially close the received transactions to change their value is what we do, right? Okay. We've kind of talked about this, but theoretically, I think this is interesting. By the way, some of these things I take directly from Microsoft when they make sense. So this isn't necessarily my wording, but it makes sense what they're saying. Receipt costs are set by the user. Well, what that means is that when you put a vendor invoice for the purchase order, you are affecting the costs for that item. When you are posting inventory into a production order, and then you're doing an end of the production order, you, the user, are affecting that receipt cost. Issue costs are done by Microsoft or the AX product automatically based on the related cost. So what they're saying is that once you put it in inventory, unless you adjust that inventory in some way, you don't control the costs that come out. With one exception, you can control it through a concept called marking. But in general, you don't control that cost on what is on the issues.
Another question that just came in about that.
Okay.
What happens if there was a GL entry to correct a PO receipt invoice, an incorrect PO receipt invoice?
And that is exactly the example that I would give you. If rather than going and fixing the purchase order, somebody independently vouchered the balance, or even almost importantly, never posted a vendor invoice. I've seen where they posted the vendor invoice independent of the purchase order. You would have inventory not reflective of the true cost. Now, if you fix it, it would still go to adjustment. So what's recommended wherever possible to go fix the purchase order, but if you've already posted the invoice incorrectly, it's pretty hard to fix at that point. So the example you say is what would you happen in the ledger? Well, first off, I'm assuming the ledger would be support the vendor invoice that where was a difference. Then you would effectively want to adjust your inventory to reflect that delta. So you would do an adjustment there. Did that satisfactorily answer?
I believe so. No follow-up.
Okay.
All right.
Okay. So really, and what I wanted to cover, and then again, we're just reciting what they call run-it average is the same as weighted average date. So what it's saying that AX automatically controls the related issue costs based on the running average. You'll notice I didn't say LIFO and FIFO, the fixed receipt price, or the standard cost. Running average means the average of your inventory at that time. And keep in mind, that's predicated on last time I ran a recalculation, because I could have all the inventory clearly in a LIFO or FIFO layer. It's still going to transact at whatever the average cost is. I want to make sure that's clear on you. You could have ran the recalculation as of last night. It's still going to use the average to post. Now, the average may be impacted, but probably not much. You're only going to affect transactions that got issued yesterday. You're not going to have transactions that got issued today. So you would post it would post at average, you would run the recalculation, and it would put it in the layer. So as long as you understand that when you're looking at transactions that are today's transactions, these are the costs you're looking at. Fixed receipt is that little flag for fixed receipt that they have, which used to be the old standard cost. In the standard cost will transact as standard cost. Fixed receipt price will transact at the fixed receipt price. All right? And everything else is running average. And again, with the exception of standard cost types, all other costing types are adjustments to the running cost, which that effectively is weighted average date. Okay, so here's the recalculation of the costing method example. Okay, and we covered this in the earlier session, but here's what we've got is we got, and just for examples, we've got 10 received at 10, 10 received at 20, 10 received at 30. So in FIFO, what we would expect is the first 10 would be costed at 10, the second 10 would be costed at 20, the third 10 would be costed at 30. LIFO, just the opposite. Okay. But what happens on the sales order, we sold it at 400, we sold at $40. But what happens then is we purchased at, and by the way, these differences are those other costs that we have. So what happened is what we purchased at $10 actually came in, was financially posted, or is posted at 108. And what's happened here is then this posted at 216 and this posted at 324. And then what we have here, you'll notice this all posted at 216. Why? Because it's the average cost. Now we do the recalculate. And we'll see here, we get an adjustment up 108 and an adjustment down 108 against this sales order. Here's now our adjusted, after the fact, cost of goods sold for these items. Again, recalculation put this in the FIFO layers. Then here's what it looks like on the actual transaction itself. You'll see that cost amount, but with this adjustment is the adjustment amount that it's making. All right? So now we're going to get into adjustments for improperly posted cost transactions. So now we're really going to get into adjustments in a little more detail, is what we want to do. Okay, again, the first statement. An adjustment is occurring to something that's been improperly financially accounted for. So it means we have ended, because otherwise it'll fix itself, right? If it's properly financially accounted for, is what the example is. This gives us an opportunity to adjust something that wasn't done properly. And here's the most vivid examples. You know, a production was ended, but didn't have all the costs posted to it, resulting in a cost of the item that was below what it should have been. Another very vivid example, inventory journals such as cycle count that didn't have a planned cost, so probably posted at 0. Well, keep in mind, and it says in here, that when you do a count journal, it is both physically and financially processed. So it's done as far as the transaction set goes. The only way to fix that is through an adjustment transaction. The most vivid example is, and I've had this call so many times, I wanted to fix my inventory costs, so I cycle counted it all out, and then I cycle counted it all back in, and it came in at 0, and we're talking about not standard cost. Well, the reason why is you had an actual cost calculation of some sort, but when you counted it totally out, if you have no inventory, you have no inventory cost on any, you know, on a non-standard cost issue. What you have is what's called a planned cost. In absence of any inventory, the system will use planned cost. That's why it's so vitally important to have planned costs. So if you think by not using standard costs, you're saving yourself a lot of time, not if you're doing it right, because you still have to have something that's representative of the cost I think it should be. And so what you would do if you didn't have that, or the planned cost was incorrect, you'd have to do an adjustment. And just so you know, the adjustment is an adjustment type of transaction. The offset to the inventory is going to be some manner of adjustment account. So I want to stress that. So you lose some granularity there, but when you look at the transaction sets in the system, they're whole. But keep in mind, in the ledger, they're posted as two separate sets of transactions. So it's a little harder to reconcile. Adjustments much harder to reconcile in the ledger. Okay. What we're seeing here is saying it's under closing and adjustment. And if you look at cost management in 365, it's also under closing and adjustment. I'm just looking at the, okay, all they're saying, you can do a recalculation at any time, but the on-hand can only be done in conjunction with an inventory close. That's all this statement is. I'm not sure exactly why I have it there, but okay. So if we go to the inventory transactions, when you do an adjustment, one of the things you've got to do is say, what am I going to adjust? So what you'll do is, but in this case, we want to adjust this item number. So there's a query associated with it, and you also can do things like, I only want to adjust for this site. So that's what I'm showing here. So the adjustment can be more granular than just the item. Like I might remember, as we talked about before, each site as a minimum carries its own individual cost. I may want to, in this case, just adjust the inventory, maybe up a percentage to cover cost of getting the inventory to Arizona. Might be a reason I might want to do this. So here's the adjustment itself. What it's saying is that I want to use the item cost price in this adjustment, and the item cost price can come from one of two places. It can come from this inventory transaction price here, which is on the price discount tab, or it can come from the cost area. If I've posted a price, it will come from this area. So in other words, it'll use the first screen unless something's been posted to this screen, and then we'll come to the date here that's been posted separately in the item price screens. So this is where it's going to get its planned cost. So then you can select, in this case, we're going to select item cost price, and we're going to explain the other ones here shortly. And what that allows you to do is we'll effectively say, based on the item cost price in my selections of this item, these are the adjustments I am going to make. And they occur in the Edit Now field. This adjustment would say if I had a previous adjustment. This Edit Now is what it's going to do to take the posted value. It's going to add $20 to this posted value effectively. Now let's look at fixed cost price. Yeah, and that should be cost. What this is doing, when I say fixed cost price, I'm going to enter a cost I want it adjusted to. And so then it creates that adjustment. Let's look at this one. 183, 74. I must have said 190, right? Or something like that. Well, again, if we add it up, we can see that. I should have shown where I entered that. I'm sorry. But fixed cost price is exactly what that is. I'm saying I'm fixing the price. Okay, now the other three methodologies, by the way, I would encourage you to go to a test system and play around with this. It's actually the best way to learn it is go in and do it and see what you get. I just want you to know that what I do all the time, and the reason why I'm not as well versed on these other ones is because I want to make sure that people have a planned cost. So when I see a problem like this, I have them go in and put a planned cost and then do their adjustment to the planned cost. That way I know next time I'm going to have a planned cost, and I'll also have something to compare against. The other methods are valid, but I'm more likely to do a planned cost. Okay? But here's your other three methods. They're called amount, value, and percent. So let's say I had a freight bill they wanted to allocate across a number of transactions. So I want to make sure we understand the subtle difference. Fixed cost price says this is what I want the item to be costed out. I'm manually entering what I want the cost to be. And the other one is item cost price, is based on whatever the plan cost for that item is for that site. And when I get to these, then amount says I've got a number of transactions selected and I've got a freight bill of $100. I want to allocate that $100 across those items. Value says I think it's an amount that will be adjusted to the fixed amount. So if I say if I say $10 value, I'm going to take those lines selected and add $10 to it. Okay, amount is an allocation. A value is a fixed amount that I'm going to up the price by, and a percent is just doing the same thing, but only based on a percentage. I really have not done any of these very often. In fact, hardly ever. I think I've done something with the amount where they forgot to have to put the freight on it and things like that. But as long as you get the concepts of what they can do, that's what's really important here. So those are your ways to adjust inventory that's already been financially accounted for. So now I'm going to go through what a real life example is, how I would actually look at the cost price report and then go through and make the adjustment before I did my inventory close. Fixed cost prices. So we see this effectively has a deviation of more than 100%. So there's something wrong. So I'd seek to do an adjustment. What I do is select item 100 in this case. The edit now field is where, based on my adjustment type, it's going to put what the adjustment's going to be. And you'll kind of notice that these are more representative than these. So these obviously got posted incorrectly. And then here's your settlements. But one of the things I want to go to, if for some reason you didn't want to adjust it, it's very simple. You just have to clear this edit now field. Okay? Because not everything I bring up I may want to adjust is kind of what the key is. And there's my adjustment settlements. You can see these are adjustments. In fact, these adjustments were made to those individual transaction sets. Then here again is the result of those adjustments. So here's your adjustment. Here's your, remember, we said this was financially accounted for. So there you are seeing in this. So again, you can see almost the total. This was received at 0, by the way, is what happened. That's why you don't have anything here. So this was received at 0. I adjusted it into a transaction that was representative of what it should have cost. Again, an after the fact adjustment. So again, a purchase order improperly processed. This is redundant, so apologize for that. Adjustment. There's your list of your 1000 F transactions, so we're just doing the same thing. Here's your edit now. Again, you can, in fact, I think we're showing next is I cleared out these edit nows here. So I'm only affecting these that I wanted to impact. And again, notice how this is showing an adjustment, and edit now shows you what additional adjustments come. So I want to make sure we know that. When you look at, here's the posted value, here's the adjustment that was made from a previous step to that posted value. And then here's your edit now, which says, this is the adjustment I'm going to make from this process. And those are the adjustments that are made. And here again, your updated transactions. That was kind of redundant with the last one, but I think you get that again. The adjustment, in this case, we did receive them at $100 or $1 a piece, but we've adjusted them so that they're $200 a piece. And again, the impact of the adjustment is vividly shown here. We're going to cover next the on-hand inventory adjustment. Again, anybody from 2012 or 2012 above do not have to do this on standard cost items. And it really shouldn't impact the other cost items, but just so you can see here, you've got an on-hand and it's selected all items with the balance. So you've got to select it as the on-hand inventory, and I'm not limiting, I'm selecting all items with the balance. And really what we're seeing here is that it brings up all items that have a balance. So edit now would show you where it anticipated doing an adjustment. And it does give you a warning. And there's the adjustments that it's made to an on-hand inventory. Okay. Okay, we're kind of right on time, maybe a little bit ahead of schedule, so maybe we'll open it up for some questions afterwards. Do we have any questions about any of the content up until now?
We don't have anything in the queue, but folks, please enter your questions if you have any now. We're getting toward the top of the hour, so be thinking about anything you'd like to ask during the Q&A. And you can continue on right now. Oh, yep, no questions. Everything has been well explained. So,
okay. And I hope I haven't been too over the top in the redundancy, but to me, this was a very mystical type of process. So I've tried to maybe go overboard in explaining all the different possibilities. So I hope that didn't, well, I don't mean to insult anybody's intelligence. I'm just saying I did it from my perspective of all the things that I did to kind of prove out these different transaction sets. So what I'm going into now is what I'm saying best practices for inventory close. And this will kind of sum up what we've talked about. Okay. First step only makes sense. Go to your test system. You can't hurt anything in your test system. You know, the thing you don't want to do in your test system, by the way, is close all inventory transactions to the end of the month in the current period, because anybody else using the test system, but anything in a previous period, feel free to go in and play around with. Do these processes. Make sure you understand what they're going to do. Make sure you know what you're going to see, because one of the hardest things to do is, if you're in the cost accounting areas, is try to explain why it did these adjustments. And so I want to make sure that you need to kind of spend some time proving out what these processes are. Another thing I want to do is advise, don't get so far behind that you've got to make huge moves. Like I've worked with companies that didn't do the closing because they didn't like what they were seeing. Well, all they did was delay the bad news to the current period. Because if they close 3 periods or 4 periods, let's say you close all those periods in between, you can't go back and make adjustments to those other periods unless you get permission to. So all the bad news is going to hit in the current period, and it's not going to be reflective of the time these problems actually occurred. So I want to encourage you to make sure that this is a process that is non-compromisable, that it's got to be done every month, period. Whether you like what you're getting out of it or not, if you don't like what you're getting out of it, fix what you're doing on the front end, because it's only trying to correct the mistakes that you have made during the process. Okay? When I say do not wait till the end of the period, I'm not talking about the close process itself. I'm talking about things like recalculations, running the cost reports, running the open reports. You can do those at any time. So go ahead and do that, and don't waste. What you want to try to do is identify the item before you run the inventory close. So you can decide, what do I want to do with this? And I want to particularly stress this for anyone who's not running standard cost. Here's the problem. If you make a $20,000 error in standard cost, somebody's going to look at that $20,000 and try to figure out what happened to it. If you make a $20,000 error in some manner of actual costing, you may not see it. And the quicker you see it, the less impact it's going to take. So run these reports and make sure you have a planned cost. And the reason why you have a planned cost, in absence of a regular cost, it will use that. And also it provides a check, more or less of an audit when you run the check cost prices on a regular basis. So you can then identify those items that were transacted incorrectly. What I recommend on standard cost systems, you manage by variance. Look at your variances and start by saying, what are my biggest variances, and start with those first. Is it a problem with standard? Is it a problem with reporting? Where does the problem occur, and make the associated corrective actions? And then for actual cost system, managed by settlements, and let me explain what I mean there. What I do when I come into a system is I go through the inventory close and I look at settlements. And what I start with is I sort them from highest to lowest. And I start with the items that represent the biggest settlements, because the biggest settlements means that's where your biggest problems are. And I can identify bad processes, all kinds of things. And I want to suggest you've got to start with the highest positive and the highest negative, because no matter which way it goes, it's a problem. So start with those items, and I'm suggesting if you're trying to fix your cost system, that's what you do. You're not going to fix everything in one day, but if you take your top 10 items and work on those and consistently try, because here's what it is. It's an indication that your process or your standards are incorrect. If you fix those, you won't get the adjustment. So the more you transact properly, the less adjustments you're going to have. The more you process incorrectly, the more adjustments you're going to have. It's really that simple. So managing by the settlements is a good way to do it, because you're focusing on your biggest cost items first. Let's see. Understand the timing. You know, post your inventory, your vendor invoices the same period as much as possible, with the understanding is it could adjust some adjustment in the next period. And your production orders within the same period. Make sure all your journals are posted. I don't know how many times I've gone out to production system and seen journals that were never posted. That's an indication of a poorly run production process. Run inventory close. Once you've had those other processes completed. Any questions on best practices?
We do have one question in the queue.
Sure.
That is, can you talk a bit about inventory adjustment journals and their use scenarios? Can they replace on-hand adjustments in the inventory close process?
No, I would not recommend it, and no, they can't necessarily. So let's talk about the relationship. What I've been talking about is other than inventory adjustment journals. And let me give you a little bit of background on this too, is that I do look at inventory adjustment journals, most specifically cycle count, to identify improper posting. Here's the problem you have with trying to use an adjustment to fix it. You most time are not fixing it. Because let me illustrate. Let's say if I have a cycle count that I had a plan cost at 0. Now I cycle counted it out at 0. I cycle counted it back in at 0. Now in theory, I could cycle count it back out, put in a plan cost, and cycle count it back in that particular scenario. Or I could have just done the adjustment. So in that case, you could fix it, but it's actually more work in fixing it that way than the other. When you get into production, though, the outputs of production, you cannot fix that necessarily with an adjustment journal because it's going to take whatever cost it thinks it's supposed to be. So you're not going to be able to fix the cost, in other words. You can fix the quantity, but you're not going to fix the cost. So let's say I had a production output and they were $10 a piece. You could adjust those out, and effectively, if you adjusted them back in, you could potentially, if you adjust 100% of them out, but think about how often can you really cycle count out all your inventory, because the only way it's going to work is to cycle count all your inventory. Otherwise, it'll just average it coming back in. I don't know if that makes sense, but you can see where inventory adjustment journals that are in just quantities, and also largely with some exceptions, and I'll illustrate what those are, that are correct mistakes. Cycle counting is correct mistakes in improperly posted transactions. Guess what? It's an indication of a company that needs to improve their process and also make it timely. Here's the key, and I probably will cover this somewhat the next. If you want a good inventory system, you've got to get to posting at the time of the transaction accuracy. And it's got to be not just quantity, it's got to be the correct location. That's why WMS is one of your single biggest, best investments in improving your inventory, because it puts the inventory transaction at the point of the transaction. And it does have reconciliation processes built into it. But again, there are some cases where you don't have a process to bring inventory in. Journals then sometimes replace that. Like I remember at Maple Lodge Farms up in Mississauga, we used the bomb journal to unbuild chickens. We'd have a chicken coming in and we'd have 2 wings, 2 legs, a breast and a back come out of the process. So there are journals that are used in place of, let's say, production processes, but most of the time when you're using an adjustment, it's to make up for an improper process, not a proper process. Okay, I hope that answered that question. Oh, by the way, I've seen people try to go crazy trying to make adjustments and end up with a different cost every time because it's averaging them back in every time if you're not doing the complete inventory. So it's hard to control the complete inventory through an adjustment process.
Thanks, Don. We're about 2 minutes to the hour, so
okay,
getting a feel for how much longer you need to go.
Not much longer. I think I went one slide yet. So
all right, great. Go ahead.
Here's some other considerations. Okay. So anytime you can fix, in other words, a ledger posting and a cost posting doesn't occur until the posting. So anything you can do to fix it before the posting, okay, it means it's going to be reflected in the posting. Once it's posted, they may have to be reversed to get them to repost. So that's always a consideration. In other words, if the purchase, don't put in purchase orders, it's zero. If you don't know what it's going to cost, get a quote first and do it through another process rather than a purchase order with zero. Okay, and we kind of covered this. What we're telling you here in the first one, cycle count will transact at what its planned cost is unless there's inventory. It'll do inventory costs provided there's inventory, and it will use that average cost, but it will in fact transact at zero if there's no inventory. Okay. We talked about that we transact at weighted average date, and you need to run the recalculation. All transactions that have never been financially closed need to be evaluated. You got something broke on one end or the other, and you need to fix it. And, you know, production orders out there not ended. You should not have any production orders out there that are from past time that have never been ended. That's just asking yourself for problems. And then when you look at costing problems, start with looking at the biggest adjustments or the biggest settlements and start with those first because they're going to give you the biggest impact. And then go down from there. So you start with different percentages too on your filtering on your variance. And these are just some reports that are out there, so you can look at those at your own time. Just some reports that are standard that I use. Okay, and that's it.
All right, thank you so much. We do not have any other questions in the queue.
Well, let me ask the group, and you can put that in your comments too. Was this the right level of detail, the right speed? Did you get something out of it? Keep in mind, we do this to get the proper outcome. Otherwise, there's no point. So I want to make sure this is one of the most comprehensive costing set of courses that has been put together. We want to make sure they're effective and we're hitting the right things. So your feedback, positive or negative, is appreciated because it's how we become better. And I would encourage you to put in what do we call it? The questionnaire at the end.
The survey, yeah. Fill out
the survey.
Yeah, fill out the survey and results. You know, you can answer these questions in the survey. We do have a few folks who have commented saying, yes, they thought it was the right speed and the right level, and they enjoyed it very much. So that was good. But we'd also love to hear from you on the survey. So please take a couple of minutes when we're done to fill that out. It's
how Julie grades me. So it's my report card.
One person, however, this is interesting, Don says, can you expand this to include a session 5 and discuss cost objects and elements?
Well, and let me answer that this way.
Sure.
Could I? Yes. But see, the problem, nobody uses that. And so it's hard for me to justify spending the kind of time it would take to get up to speed on that, on something that nobody uses. And we're talking about what Dynamics calls the cost accounting module, which in a way is cost accounting, because cost accounting takes in frameworks on saying, like, how do I allocate maintenance fees to these other departments and things like that. But it is not a core need for most of the AX. So I'll consider it if there's enough demand, but I want to make sure people understand that hardly anybody's using it. What I taught you is what I consider cost accounting. And in previous version, it came from a number of different modules. In 365, it comes from cost management. And the only reason why I didn't say in the beginning this is cost management is there is no cost management in previous versions. I usually say this if I started to listen to the recording from session 1 to try to catch if I did say it, but I usually kind of put a disclaimer in there saying what they say is cost accounting isn't really cost accounting. And all I'm suggesting is, rather than do that, I would rather spend my time on dealing with maybe teaching production, teaching more detailed courses at this level for inventory, production, and maybe project. And I would think get some independent person, if we can find one who's well versed in that product area. I don't think I've never heard of a session on that module, by the way, ever. And I know that's not what they want to hear, that individual wants to hear, but it's quite honestly, I wouldn't waste my time on it unless you have a specific application for it. And then I would seek out an expert in that area. And,
right.
Unfortunately, that I don't know of one, but we could probably find one.
All right. Thank you.
I think it's a disservice because it's confusing to the people using the system, is really what I think.
All right.
Okay.
Thank you so much. And there are no other questions in the queue. So with that, I want to remind you all to attend our next webinar, the final in this series, in 2 weeks on a Tuesday. And with that, I'll close the webinar and wish you all a good week. Thank you, Don.
Yeah, and thank you all for attending. I'm honored to be able to speak with you.